Go live now to the Assistant Professor of Economics at George Washington Uni, Stephen Hamilton, on this number that's come out from the ABS today. We're going to hear from the Treasurer shortly, but this, doesn't it, torpedo the suggestion, I think, from someone in the RBA, one of the senior figures in recent months, who said the economy's running too hot, Stephen. It's far from that.
Yeah, so it came in a little weaker than expected, but, more or less in line with, I think, where we thought it would be and where the RBA thought it would be. So I don't think there's, frankly, a lot of news in it. It's what we thought before. It's what you guys were just saying, which is the economy grew by 0.3, public investment grew by 0.3, public demand grew by 0.3. So without the public, that is the government, GDP growth would have gone backwards, right, by 0.3. So, that's a story we've been hearing over and over again, which is the government is expanding at a record rate. Government employment is expanding at a record rate. The RBA is trying to slow the economy while the government expands. The rest of the economy has to bear all of that pressure, and as a result has to shrink to fit. And that story continues.
The RBA had forecast growth at the end of the year of 1.5%. Isn't this 0.8%? Isn't that enough to make them rethink the trajectory on rates?
Well, I think so. There's two things to say. One is, nobody actually cares about GDP growth in a given quarter in the sense of the RBA's mandate. The RBA doesn't have a mandate to increase GDP growth. They have a mandate to get inflation back to target, and they have a mandate to maintain full employment. They seem to be achieving full employment pretty well, and inflation is coming down in line with their forecasts. Now, the reason the GDP growth number might be important for the RBA is it may signal where inflation goes in the future, right? If the economy is slowing a lot more than expected, then maybe they can expect that inflation will come down more quickly than expected. I don't really take that message from this release. I think it's roughly in line with where we thought it would be. We see, again, very rapid government spending growth and subdued, private sector in line with, everything that everyone has been saying all along. And I would point to this point that Andrew made, which is in recent kind of few months, we've seen a pickup in retail spending. We've seen a kind of resurgence in consumer demand. And this only goes to the September quarter, right? So we've had, a couple of months since this GDP growth figure of activity, and we'll have to wait until the new year in order to know whether that story is coming to bear.
So the RBA, there's no chance of any move before Christmas?
No, none whatsoever. And I would say in the last minutes, this was kind of looked over by a lot of people. In the last minutes that the RBA released from their last meeting, they said very clearly they're going to need to see two quarterly inflation figures that are below expectations in order to get rates coming down. And that means, there's just not enough time for the RBA to see two quarterly inflation figures below expectations before the next election. So I think what they were signaling with that comment, which they deliberately included, I think it was a signal to the government to say, don't expect a rate cut before the next election.
George Washington University Assistant Professor of Economics, Stephen Hamilton. Great to get your insights as always. Thank you. Appreciate it.